And everyone, and welcome to the ASIS Economist Board, where we discuss the current economic environment as it relates to industrial production. Each of our industrial production models incorporates data from approximately 18 to 20 economic indices with data going back over 20 years. In this video and in the 7 related subsector videos, we'll dig into what's driving each of our forecasting models. And then we're going to relate it to what we are seeing in the real world. And that's some of my job, is kind of be the dummy that says, Keith, what does this mean? And more importantly, where we see things heading and why. I'm John Nelson from M&A, and I'm joined by Keith Prather of Armada. How you doing today, Keith?
I'm doing great. Fantastic. I'm ready to get this thing going.
All right. So you ready to get into industrial production?
Yeah, let's talk economics. All
right. I'm going to go ahead and I'm going to share our first ASIS model, put my cheaters on so I can see what I'm talking about. And I'm going to go over here to screen 2. Industrial production for manufacturing. Kind of an interesting story. For many months, we've been, for the last several months, we've been talking about this kind of general rise, and the trend kind of continues, driven a lot by the bounce back on the inventories that we've seen, getting control of the inventories. But for the last couple months, it's a little bit more severe now. We're seeing this gradual tapering off beginning in Q1 of 2022. And what I'm seeing in the models is that we're picking up that merchant wholesaler sales and inventories problems are really kind of driving this gradual slope down. It's not huge. It is still about 5 percentage points over time. So I've been thinking a lot about inflation and things like that, and been wondering, what's your take, and where do you think this is going, Keith?
Yeah, I mean, you can't flip on the nightly news without inflation being a top story. Whether it's hitting consumer goods, whether it's hitting commercial goods, producers in the manufacturing sector. I mean, have been feeling it for a year or more now, but it's finally kind of hitting the consumer sector. So we're starting to finally see a little bit of deterioration in consumer sentiment. And a couple things that I'll talk about just sort of off the cuff real fast is that, prior to the pandemic, U.S. savings rates, were down at a level that we've seen consistently for about the last 10 years. And then during the pandemic, U.S. consumers built up a war chest, if you will, of about $2.5 trillion in excess savings. So we started to get out of the lockdown period, and obviously all that spending kind of released. And so we saw some heavy consumption late last year and early this year. We're now down to a point where consumers have literally, we're sitting somewhere around $300 billion in surplus. So we have spent a little over $2.2 trillion in consumer savings that have, basically come out of banks and have been, working in the economy, and that's fantastic. But what's happening now is that as we start to see inflationary pressure build, U.S. households are finding it more difficult to find a little bit of extra discretionary income to go buy the stuff that they have been buying. And what's fascinating about the models, I think the model is picking up on some of that pressure. It's picking up on some of those metrics that are showing a little bit of slowing in consumer spending, a little bit of slowing in sort of housing construction, some of the just general kind of just, it's not recession, but it just feels like deceleration. And that's kind of what's happening across the board, and it's starting to show up, and the models are picking it up.
One thing I know that the models won't pick up are like big policy shifts or policy changes. If the current administration makes a big shift in it, we're going to probably see a correction to the models one way or the other. Do you see any headwinds on that one way or the other?
Well, when you and I built the models, we did a little bit of that thinking, right? So the whole idea was that we try to put metrics into this that help it see forward. And it should be really sensitive. I've been really happy with the way the models have performed and the sensitivity to, very slight changes that we're seeing in the economy, and then how that kind of ripples over a period of time. And so, with the latest policy talk, especially with the passing of the infrastructure bill, we're just waiting on President Biden to sign it. You'll start to see a little bit of improvement in some markets. It's going to overheat inflation in others, but we're going to see a fairly, it's almost going to replace some of the stimulus spending that we have been seeing, and that'll kind of keep things at equilibrium, if you will.
Right.
But right now, the biggest impact would be as we start to see a little bit of impact on taxes. You start to see it impact consumer sentiment, and the model definitely picks up consumer sentiment. Um, so anyway, I do think it is sensitive enough to start to pick it up as soon as it
Okay.
really hits the market, and the average consumer, Joe Blows like you and I, really start to pay attention to it and really starts to impact our daily lives. So.
All right. Well, one thing you always emphasize perspective in terms of what's it look like over time. And we were just talking about this before the break. You can kind of see where that trend is. That dip, I was contending wasn't so significant, but it was, the 10-year trend was hovering around, or the 8-year trend rather was hovering around that 100 mark, bumping up and above it. And you can see that we're taking a look at it right now, that the overall model is kind of shifting it down to levels that were closer to, early 2010.
Yeah, you and I talked about this, not to diminish the value of a single month report, but I mean, this is where the trending is important. And we want to see kind of what happens as we get new data rolling in, and we kind of see next month's trend to see if it continues this downturn. But yeah, this is concerning. I mean, when you see a model like this, and the accuracy rates on our models have been fantastic. So, not trying to brag or anything, but I mean, when you're running in the high 90s, you start to build a lot of confidence in what you're seeing. And this worries me quite a bit. We do know that a lot of manufacturers are building inventories at a faster rate. So I was able to speak in Dallas at a conference. We had about 1,000 manufacturers of construction materials there. And a lot of them were saying that, early in the year, they were short, maybe 7 or 8 different components to be able to crank a finished product off the assembly line. And now they're kind of to the point where they're just missing one. So what that's done to them, though, is those other 4 or 5 items that they had been waiting on all year long and been reordering, they now have some inventory built up. And so the orders of those items are now starting to slow down a little bit. And so, so we're seeing the softening. I also tell you just a couple additional anecdotes, but if you look at container rates, so container rates moving a TE or a single container out of China to the US West Coast 30 days ago cost you about $20,000 to be able to do that. Rates dropped over 14 days to about $16,000, which was kind of interesting. But now spot rates coming out of China are down below $11,000 per TEU. So it's 50% lower over the last 30 days to move a container inbound from Asia, which says something about demand. Capacity really hasn't changed dramatically. We're starting to see a few more empty ships, a little more scrambling, but something's happening on the demand side. The one other anecdote I've got is there's a thing called the Baltic Dry Index, and it's one of the oldest indexes in the world. And the BDI just basically measures the cost to move bulk materials. So steel, aluminum, copper, bulk food, stuff like that. But primarily those early inputs into manufacturing. And for decades, Wall Street has watched this metric because typically when the BDI moves up or down, it signals a change in manufacturing anywhere from 6 to 12 weeks later. And so what we're seeing in the BDI is the BDI has fallen 50% over the last 30 days. Now it's still 30% higher than it was a year ago, so it's still elevated. But on a global basis, we're starting to see some shift in commodity demand, inputs of raw materials, and it's just fascinating that we're starting to see the same kind of trend show up in IPMAN.
Got it. Let's take a look at year over year. It's interesting when we just kind of showed that big downturn and we saw how everything was trending, but you can still see this is the current year. We don't go out and show the 18-month on the trend, and the current year being in that red, but we're still kind of right there in the mix, at least how it's performing right now year over year. I really need to kind of put 2022 on the chart soon, so we can, the fact that we'll do that next month, get 2022 on the chart, probably drop 2014 off so we can get a better look. But any comments on the year over year?
No, I mean, it's what we expect, right? And it just is, again, so shocking because, if you throw the 2022 chart up there, you're going to see a precipitous decline, and it's going to start to dip below a lot of these other lines. So, I mean, we'll see what happens again. I think we do need to get, October, November data and get the actuals out and see what happens with growth. But yeah, it just kind of average, you know.
Yeah.
Now I think what we'll find in the other sectors, and if you're able to watch, and if you aren't subscribing, or if you're not on a trial to the ASIS, you're going to want to see those other 7 subsectors, because those other 7 subsectors, we've got some real champions in some of those markets. So we've got some really strong growth curves and some really optimistic 2022s for at least 50% of those other durable goods sectors. So that's it's an important one to watch.
It is interesting because they're not all tracking exactly the same trajectory. They all kind of look a little bit different. So it is really interesting when you look at the models and the outlooks for the different sectors.
It is, and that's one of the reasons why we did want to divide it down into those subsectors, because it does make a huge difference. So,
sure.
Yep.
All right. Well, that's our report for IPMAN this month. We hope that you're taking a look at our subsector videos. Kind of puts a little bit more context around the ASIS report when you get it. So otherwise, we will talk to you next time.
All right, take care.